You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Thank you so much, as always, for listening. Should I stop funding my whole life policy for the infinite banking concept as soon as possible? Well, the short answer is no, definitely not. I'm sure that's surprising. I've had many conversations in recent months where people are asking, how soon can they stop funding? Or can I stop funding after 10 years? Or something like that. The real question is, do you expect all cash flow to stop in 10 years or whenever you're thinking of stopping? Or when will you no longer have the need to store your dollars? When would you no longer like to have control of your money? Because as long as you have cash flow, you are going to need a place to store dollars. And of course, you won't be storing all of your cash flow inside of a whole life policy or more than one whole life policy. But where's the best place to store your savings? A savings account? The stock market? How about a whole life insurance? So any dollars you do want to save and store away, either as emergency savings, vacation savings, retirement savings, why wouldn't you want to store those dollars inside of whole life contracts rather than the bank? There have been over 500 bank failures since the year 2000. Let's just keep that in mind. And people always mention the safety of FDIC. And that's one reason why they may want to put money or keep savings in the bank because of FDIC. They're protected. But is it really that great? The government only has about 1% reserved for all the dollars currently in savings accounts at banks. So I really don't feel that great about FDIC. In addition, in order for them to provide this protection, this FDIC coverage, they have to tax us. They have to take it in the form of taxes. So we're all paying in taxes to be able to protect our own bank accounts. And then again, they don't even have nearly enough money to protect all bank accounts, or of course, not all the money. We know that there is a limit in general. Therefore, I feel that my dollars are much more protected within a whole life policy at a mutual life insurance company. As I mentioned in a recent podcast, I believe actually it was last week's podcast when I was just going over some benefits to whole life contracts. There are many benefits. Things like guaranteed cash value, which I know is top of mind. It's one of the obvious ones. Dividends paid when you're with a mutual life insurance company and a whole life contract, you'll be receiving dividends. Liquidity, you can access your cash value anytime and no questions asked. A lot of people ask how soon they can access the cash value. It's about 15 days, 2 weeks after you make a payment. You can access it sooner. We're just going to need a snapshot of your bank account to make sure it went through on your end. But otherwise, you have access to cash when you need it. It comes with living benefits, which of course your savings account or stock market account do not come with. It is creditor protected in most states. You have the ability to borrow against your cash value. Again, one of the magical things about the infinite banking concept. And you have a much larger benefit that will be paid to your family should something happen to you prematurely when you pass away. Now, the money in your savings account or the money in a stock market account will just get paid out to family minus any taxes due, not a huge death benefit that comes tax-free instead. And of course, you have access to the cash within the policy, or you have access to the cash value, income tax-free. So for me, this is where I store my savings dollars. And if I've planned well for my elderly years, I'm still going to need a place to store dollars. And once my policy has become cash flowing, why wouldn't I want to trade my premium for 2 times as much growth or 3 times as much growth in my cash value? I'll trade $10,000 for access to $20,000 all day long. I'll trade $10,000 for access to $30,000 all day long. I told this story about one of my clients, actually happens to be a relative, a couple of years ago. in a podcast. This relative of mine is one of the very few people I've helped with no prior reading or learning, because we have always required that the client first reads Becoming Your Own Banker by Nelson Nash before sitting down for an IBC consultation, because that just helps with your own learning and knowledge, and it gives you a foundational place from which to build on your learning and your knowledge. If you come in cold, don't know very much, and you just want to learn from scratch from an advisor or a practitioner, it's going to be a lot harder to get your head around. It's going to be too much information at once. So we've always required that someone read the book first. So anyhow, this person, he is very close to me. He was younger. And so he did learn at the time when I was teaching him, and he wanted to proceed, but then naturally forgot almost everything within no time because he wasn't actively learning when I was teaching him. We have gotten together since a few times to go over his accounts, and each time he was reignited and excited about the infinite banking concept and his policies. And each time before long, he forgot all the excitement. But a couple of years ago, he came to me super excited because he had started paying more attention to his accounts. So he came to me and said, Val, the coolest thing happened. I sent in my $3,000 annual payment, and I wanted to make sure that it got credited to my account. So I looked up the account value before I sent in the money, and then I looked it up again after I sent the money, and my account went up by $5,000. I made $2,000. Like, he was so excited. And I just laughed because, of course, I had described how this policy would become cash flowing and do exactly that once the policy had aged a bit. You might be expecting this kind of growth right away, but remember, there are startup costs to your system, also known as the cost of insurance. But just like any business or piece of real estate that you expect to become cash flowing, there is a startup cost to your system, your banking system. Usually that startup cost in a brick and mortar type of business is going to be the real estate you had to acquire, or the structure you had to have built, the inventory you had to buy, and the employees that you have to hire. For a rental property that you expect to become cash flowing, it would be the down payment on the home or remodel costs. For your whole life policy, it's the cost of the death benefit. So unlike the value of the startup cost items with these other examples of businesses, the startup costs associated with your whole life policy are actually providing quite a benefit to your loved ones should something happen to you prematurely. If I spent $40,000 to build and prepare a new espresso stand business, which I did do, if something happened to me the next day, my family would have to try and sell the business or sell the inventory, the building, etc., everything separately. There wouldn't really have been a business yet if I hadn't established it, but all the stuff would be there. They'd probably have to sell the different parts and pieces and machines and all that separately, rather than receive a windfall of cash valued at much more than my startup cost. But anyhow, I really just wanted to point out that if your goal is, how soon can I stop paying for this? You're missing out on how valuable the policy can continue to be the longer you're able to fund. The power of continuing to add premiums to a well-seasoned policy will just keep your snowball of savings and other benefits, dividends and everything rolling and building. Now, if you get to an age where you would like to start pulling passive income from the policy, we would take a look at that time to see what makes more sense to continue funding or not. But until you get to that decision-making time of your life, it's best to continue funding and just to plan on continued funding. Try not to look at the premium as a bill or just another expense in your life. Rather, it is an asset you are building for yourself and your family, a financing tool that you can utilize all of your life for every need or want that you're able to run through it. The more you fund, the larger the pool of cash from which you can take over other outside debts, such as school loans or mortgages or credit card debt, and start redirecting that interest earnings or those interest earnings to yourself. The larger your pool of cash, the larger investment you can make through your system, creating other cash flowing opportunities as well. Whole life is a cash flowing asset that gets better with time and added dollars. You will always need a place to store cash, and whole life is, in my book, the greatest place to store your cash. Now, will the policy grow efficiently if you were to stop the premium at, say, after 10 years or 20 years? Yes, it absolutely will. but you will have less cash in the long run because you put less in. If you're stopping premium on your policy in only 10 years, I would suggest you start another for those dollars that you were putting in that you'll need to still store somewhere unless you really have a reduction in your cash flow. Of course, different people have different needs, different goals, and different resources. And so one person's plan is not going to be the same for someone else. There is the occasional situation when it does make sense to only fund for 10 years or 20 years or somewhere in between. Everyone is different, and so I won't say as a blanket statement that no one should ever do it. I just think for the majority, it makes more sense to continue funding if you're able to. Well, okay. I hope all of that was helpful learning for you today. If you feel that your learning is at a point where you're ready to act, ready to begin a banking system and get your whole life policy started for you or your family or some member in your family, and you feel that I would be a good advisor for you on this journey and you would like to partner with me, feel free to reach out. You can reach me at Valerie@alphaomegawealth.com. I would love to meet you, learn what's important to you, what your goals are, what you already have in motion to try to achieve those goals. And I would love to learn how you would like to utilize your newly implemented banking system and help you get started. I appreciate you all. Have a great week.